Is the American economy on the brink of a bigger crisis than we realize? Could Trump's tariffs be the catalyst that tips everything over the edge? The American economy isn't in great nick at the moment. Trump's tariffs have crippled the stock market, spooked international investors, and pushed the U.S. towards recession. But the crisis is now spreading beyond the stock market. In this video, we're going to have a look at why the markets have responded so negatively to Trump's tariffs, and why this crisis is even worse than it looks at first glance. Why have the markets reacted so negatively to Trump's tariffs? Because usually, tariffs don't provoke such severe reactions from markets. That's because while tariffs do have some negative economic consequences, they usually don't have that much of an immediate impact on GDP growth. If you put tariffs on foreign cars, for instance, that's inconvenient for anyone who wants to import a cheap car from another country, because they have to buy a more expensive one that's manufactured domestically. But the consumer is actually spending more money than they would otherwise, and it's going to a domestic business which can reinvest it or spend it on wages. Sure, the economy is less efficient, which will put a drag on growth in the longer term and maybe increase inflation. But in the short term, there's not much of an impact. Trump's tariffs are different for at least two reasons. First, their scope and severity. Usually, when a country imposes tariffs, it's to protect a specific industry. Last year, for instance, the Biden administration put massive tariffs on Chinese electric vehicles in an attempt to protect American EV manufacturers from Chinese competitors like BYD and Xiaomi. Trump, however, has put a 10% tariff on everything, and then higher tariffs on most of America's trading partners with only very limited exemptions. This means America's average tariff rate is now just over 23%, 6 times what it was last year, and the highest in more than a century. This also means tariffs could backfire. While targeted tariffs might shield America from international competition, flat tariffs like the ones Trump's imposed will make all their imported components more expensive, potentially making them less competitive overall. Second, the immense uncertainty involved. No one knows how long Trump's tariffs will last, what recipient countries have to do to get them off, or whether they'll go up or down in the future. The Federal Reserve's so-called Trade Policy Uncertainty Index is literally off the charts, the highest it's ever been. Uncertainty is terrible for an economy, because it encourages businesses and consumers to hide their money away instead of investing or spending. It's also terrible for Trump's stated project of reindustrialization, because reindustrializing America would require trillions of dollars of sustained investment. Anyway, this is why markets have reacted so negatively to Trump's tariffs. Goldman Sachs, for instance, thinks a recession is more likely than not if Trump's tariffs take effect, up from 20% a month ago. Betting markets like Polymarket and Kalshi currently put the odds at over 60%, up from 20% in February. Looming threat of a recession has wrought havoc on the American stock market. The S&P 500, a weighted index of the 500 biggest American companies, is currently down about 20% from its February peak and is seesawing wildly. While it's true that the stock market isn't the real economy, this American economy relies more than ever on demand from the richest 10% of earners, who now account for half of all spending, and whose spending patterns are disproportionately affected by movements in the stock market. However, while the stock market decline and the prospect of a recession have clearly attracted the most media attention, peek under the proverbial bonnet, and this crash starts to look even scarier. First, the media's focus on stocks obscures the worrying movements we're seeing in American government bonds, otherwise known as treasuries. Usually, during times of crisis, stocks decline but treasuries rally, as investors shift their money from risky stocks to safer bonds. This time, however, that's not happening. Instead, people are actually selling treasuries at the same time as stocks, which is why the yield on treasuries, in other words, the interest that the U.S. has to pay on its debt, is rising. On Monday, for instance, the yield on 10-year treasuries rose from just below 3.9% to just below 4.2%. which is a pretty enormous single-day movement for treasuries. This is bad news for Trump for two reasons. First, it suggests that investors no longer see the U.S. as a safe place to park their money. Second, it will put even more strain on America's precarious fiscal position. As we've detailed in previous videos, and as you probably already know, the federal government has an enormous debt burden, representing something like 120% of GDP, and is currently running a massive deficit of around 6% of GDP. Things already looked like they'd get worse under Trump, because he wants trillions of dollars in tax cuts without equivalent spending cuts, and DOGE has failed to really make a dent in the budget. But if the U.S. slips into recession, which means lower tax revenues, and Treasury yields stay high because investors no longer see Treasuries as a safe, recession-proof asset, a full-blown debt crisis could be on the cards. Something similar has happened to the dollar as well. Like Treasuries, the dollar used to be seen as a safe haven asset, which meant that it usually rallied during times of uncertainty, even while American stocks were falling. Most analysts also thought Trump's tariffs would put upwards pressure on the dollar, both because, again, it's seen as a safe asset, but also because Trump's tariffs will probably have more of a negative impact on America's trading partners than on America, which would put downwards pressure on their currencies and therefore boost the dollar. However, that's not what's happened. As you can sort of see from looking at this chart, which measures the dollar's strength against a basket of other currencies, the dollar has actually been falling for the past few months. Again, this is bad news, because it suggests global confidence in the dollar is waning, but also because it threatens to stoke inflation. One of the reasons people thought Trump could essentially get away with his tariffs was because even if they introduced some friction into America's trading relationships, which would in theory stoke inflation, this could be mostly offset by the subsequent strengthening of the dollar, which would make all imports cheaper for the average American. A weak dollar, however, threatens to actually exacerbate any tariff-induced inflation, which is why analysts are now fretting about the possibility of inflation going back up to the 5% range. If this happens, not only would it be terrible for American consumers, it would also set Trump up for a showdown with the Federal Reserve, with Trump pushing for interest rate cuts to stimulate growth, and the Fed pushing for pauses or even hikes to stem inflation. And if Trump were to steamroll or ignore the Fed in some way, which feels increasingly likely, we could see a crisis of confidence more severe than anything in modern history. With that said, thanks for watching, and until next time.